Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The day of events start off with the Indian budget. Today, our finance minister will be presenting the budget at 11 a.m. Of course, a lot of people would be keen to know whether there would be any tax reforms. We will also be tracking whether there are any reforms which might attract flows to the country. The global markets will be looking at FOMC outcome. A 25 basis hike is widely anticipated by the markets, and people would be keenly looking at the commentary. JK, what are your thoughts? What will you be paying attention to with respect to both these events?
Yeah, good morning. Yes, I think budget is definitely on the radar immediately for the Indian markets. In fact, all segments of the Indian market, because we had equity market turbulence, and then a good budget can actually settle the issue there. In the sense, at least the bearish tilt might be twisted to the upside with a good budget. And on the bond side, yes, I think there are some people hoping that market or rather the government may still move towards including Indian bonds in the global bond index. Although the issues which are serving as a stumbling block for it was not easy to resolve. So we will look forward to it as a big thing. And for the currency as well, because looking at the kind of POP that we are faced with, current account and trade deficit, I think something really seriously needs to be done to improve flows into India. Otherwise, I'm seeing that the rupee's performance for 2023 should be, once again, one of underperformance. And just to give you a perspective, we had an outflow of 16.5 billion outflow in 2022. And the first month of 2023 has seen another 3.2 billion of outflow. And the criticality of, current account and trade deficit to be matched with the flows cannot be overemphasized. And what the budget will do to do this is something. So these are the things I'm looking forward to in the budget. And of course, the numbers will play a part. The deficit to GDP, which for the year might be pegged at 6.46% versus 6.4% that was being expected. But for the coming year, it might be at 5.82%, and overall expenditure could be higher, but that is par for the course, because the economy needs to maintain its growth also. And the nominal GDP, which is expected to grow at 6.7% year on year, will be a boost for increasing our revenues as well. And as far as the markets are concerned, yesterday rupee saw some more life into it because it weakened more than 50 paisa in one session compared to its previous close. Once again, as I mentioned, the big outflow of yesterday and with no matching inflows was the reason, and break of resistance at 81.80 brought in more stop losses as usual, and short covering took it to 82.07 before people took a view that before budget one should not be long. So that could be the reason why it has come off, particularly after dollar index weekend in the overseas market. Rupee made some sort of a recovery. Expect it to be a bit choppy today, and but overall, I think without any major announcement regarding attracting foreign inflows, I think rupee will eventually be under pressure. This is what I expect. On the data leading up to the FOMC, there have been a plethora of numbers yesterday, and starting with the Chinese PMI, where the services number vaulted to 54.4 from 41.6 in December. Not disappointing those who had hoped for a big rebound in the second largest economy post removal of COVID restrictions. Australian retail sales number was a shocker, coming at minus 3.9 versus minus 0.2 expected. And Germany was no different, falling, retail sales falling 5.3% month on month from 1.9 previous month. That was positive actually, and estimated was 0.2%. And the retail sales also fell by 6.4% in year-on-year terms. So coming on the heels of a lower than expected GDP, which we mentioned to you in the earlier update, the largest economy in the Eurozone, confirmed it is struggling with high inflation and rising interest costs. But somewhat making up for the disappointment from Germany, Eurozone eked out a growth in the final quarter of 2022, managing to avoid a recession even as sky-high energy costs, waning confidence, and rising interest rates took a toll on the economy. Fourth quarter GDP came at plus 0.1% versus minus 0.1 that was expected. In US, it was a mixed bag. House prices moderated further. Chicago PMI, an index of strength in the manufacturing in Chicago area, saw declines in January, which was the fifth month in a row. US consumer confidence unexpectedly fell in January as households continued to worry about economy's prospects over the next 6 months, as per Conference Board's survey. And the index itself dropped to 107.1 from 109. But the worrying factor was consumers' 12-month inflation expectation rising to 6.8% from 6.6% last month. That this is something which is different from what we've been seeing of late. Inflation expectations moving up, although it is still much lower than 7.9% high, which was seen earlier in 2022. Moderation in wage inflation was a good news, which Powell definitely will take heart from. Employment cost index showed it increased at a much slower pace in fourth quarter, coming at 1% versus 1.2% in the previous quarter. But Fed officials consider ECI as an important inflation gauge because it adjusts for occupations that are higher in demand and for outsized wage gains. Some weak data, particularly on wage inflation, coming close to Fed meeting underway. Market brought back bonds and the yields fell across tenors. Market is still divided on Fed's outlook and the message, whether it will be dovish tilted. With more data on jobs market slated today, ADP and JOLTS, as well as the construction spending and ISM manufacturing, still recall the big drop last month. Buyers have been active in the bonds, also taking heart from the moderation in German data earlier in the day. Stocks took a similar dovish view on Fed, with the biggest reaction seen in equities, with S&P 500 so far at 1%, reversing the weakness that was seen in the futures earlier in the day. Interestingly, for all the talk of recession ahead, NASDAQ 1.14% gain for January is its biggest January advance since 2001 and its biggest monthly advance since July 2022. Dollar index had a two-way action on the day, with the European session seeing a greenback gain on the back of euro falling with German data. But renewed weakness seen in US data and lower wage inflation has driven the single currency higher and the dollar lower. We still favor a correction higher in the dollar index due to overbought conditions, and hence any FOMC-induced fall to new cycle low can be quickly reversed. So on to the FOMC, Fed is widely expected to lift rates by 25 basis points, which is broadly as priced in by the market as well. Much of the focus will be on Powell's press conference and how hawkish or dovish he will be. We feel he will again emphasize policy dependent on data while taking care not to sound dovish, keeping in mind the still easy financial conditions which can see the inflation rear its ugly head. So even if it does sound a bit hawkish, it's all about whether or not market believes in that narrative at that point. So just to end this with some good news for the gold bulls. Central banks added a whopping 1,136 tons of gold worth some 70 billion to their stocks in 2022, by far the most in any year since 1967. This is as per the World Gold Council report, which was published on Tuesday. So the data underlines a shift in the attitude to gold since 90s and 2000s, when the central banks, particularly those in Western Europe, that own a lot of billion, had sold tons of gold in that time. So definitely a shift in the gold perspective from the central banks, definitely putting a floor to gold prices internationally. Thank you. All the best for the events ahead.
Thank you, JK. That was well covered. And just to summarize, with respect to Indian budget, some things which JK is looking at is whether or not the issues with the global bond inclusion is ironed out. Some other reforms that might be undertaken to solve the BOP problem, and what kind of fiscal deficit numbers the budget might project. Rupee yesterday weakened more than 50 basis, which was majorly because of a big outflow. We had a plethora of data leading up to FOMC, including the Chinese PMI, Australian retail sales, which came in much lower than expected. Eurozone also managed to avoid a recession in 2022 despite so many headwinds. Uh, as JK mentioned, markets can be very volatile during this period, and we keep saying, keep managing your risk. That's it from us today. Thank you so much for listening.